The Indian stock market operates as a platform for buying and selling shares, bonds, commodities, and other financial instruments. It functions in a similar way to other global stock markets, but has its own structure and regulations. Here's a breakdown of how the Indian stock market works. 1. Exchanges. The two main stock exchanges in India are 1. Bombay Stock Exchange, BSE, established in 1875, it's one of the oldest stock exchanges in Asia. 2. National Stock Exchange, NSE, established in 1992, it's the largest stock exchange in India by market capitalization and volume of trading. These exchanges are where stocks and other securities are traded. 2. Participants. Several participants are involved in the functioning of the stock market. 1. Investors, individuals, institutional investors, and mutual funds who buy and sell shares. 2. Brokers, authorized individuals or firms who act as intermediaries between investors and the stock exchange. 3. Companies, they issue stocks, equity, and bonds to raise capital. 4. Regulators. The Securities and Exchange Board of India, SEBI, regulates the stock market, ensuring fair practices, transparency, and investor protection. 3. Trading process. The process of trading in the Indian stock market generally follows these steps: opening a demat and trading account. 1. A demat account holds the securities, shares, bonds, etc., in electronic form. 2. A trading account is used to buy and sell these securities. 3. Investors can open these accounts with registered brokers or banks. Placing orders. 1. Investors place buy or sell orders through a broker. 1. These orders can be placed online via trading platforms or directly through a broker's office. 2. There are various types of orders like market orders, limit orders, stop-loss orders, etc. Order matching. 1. The stock exchange matches buy and sell orders using an automated system. 1. If an investor places a buy order for a stock at a certain price and someone places a sell order at that price, the transaction is executed. Settlement. 1. Once the order is matched, the settlement process takes place. 1. In India, the settlement is done on a T+2 basis, meaning the trade is settled 2 business days after the transaction date. 2. The buyer pays for the securities, and the seller delivers them. 4. Types of securities traded. 1. Stocks/equity, ownership in a company, where shareholders can earn dividends and have voting rights. 2. Bonds/debt, loans issued by companies or the government to raise funds. 3. Derivatives, contracts like futures and options based on the value of underlying assets like stocks, indices, or commodities. 4. Mutual funds, pools of money from various investors to invest in a diversified portfolio of stocks, bonds, etc. 5. ETFs, exchange-traded funds, investment funds that track a specific index or sector and can be bought/sold like stocks. 5. Market indices. 1. Sensex, the Bombay Stock Exchange Sensitive Index, composed of 30 large and well-established companies, is the most widely tracked index in India. 2. Nifty, the National Stock Exchange 50, which tracks the performance of the top 50 companies listed on the NSE. 6. Regulation and oversight. The Securities and Exchange Board of India, SEBI, is the primary regulator of the Indian stock market. It ensures 1. Fair trading practices. 2. Transparency and disclosures by companies. 3. Protection of investor interests. 4. Prevention of market manipulation, insider trading, and other unethical practices. 7. Types of markets. 1. Primary market. This is where companies issue new stocks and bonds, through initial public offerings (IPOs), to raise capital. 2. Secondary market. Once securities are issued in the primary market, they can be bought and sold in the secondary market. 2. The BSE and NSE are secondary markets. 8. Market hours. 1. The Indian stock market operates from 9:15 a.m. to 3:30 p.m. on weekdays, Monday to Friday, with a 15-minute break for lunch between 1 p.m. and 1:15 p.m. 2. It is closed on weekends and public holidays. 9. Factors affecting the market. 1. Economic indicators, GDP growth, inflation, unemployment rates, etc., influence investor sentiment. 2. Company performance, earnings, revenue, and profitability of companies affect stock prices. 3. Government policies, policies related to taxation, subsidies, trade, and regulations can impact market performance. 4. Global events, global market trends, geopolitical events, and economic conditions can influence the Indian stock market. 10. Trading strategies. 1. Long-term investment, buying and holding stocks for years, benefiting from price appreciation and dividends. 2. Day trading, buying and selling stocks on the same day to profit from short-term price movements. 3. Swing trading, holding stocks for a few days or weeks to capitalize on short to medium-term price trends. 4. Technical analysis, using historical price charts and patterns to predict future price movements. 5. Fundamental analysis, evaluating a company's financial health, market position, and growth prospects to determine its stock's value. Conclusion: the Indian stock market provides a platform for investors to participate in the growth of companies and the economy. It is regulated to ensure fair practices, and investors can engage through brokers, using various strategies. Understanding how it works is key to making informed investment decisions. Like and subscribe for more.